recession-proof investments to buy before it's too late. Economic cycles are inevitable. Markets rise, markets fall. But the real question isn't if a recession is coming, it's when, and more importantly, are you ready for it? Because while most people panic, the smart ones prepare. They shift their focus from risky trends to time-tested strategies. They move their money into assets that don't just survive downturns, they grow through them. This video breaks down the smartest, most resilient investments you can make before the economy takes another dive. Recession-proof assets that protect your future while everyone else scrambles. Let's dive into each one in detail. First, dividend-paying stocks. In a shaky economy, growth stocks collapse fast, but dividend stocks keep paying you, even when the market bleeds. Companies that consistently pay dividends are usually stable, mature, and cash-rich, and they often operate in essential industries like utilities, healthcare, and consumer staples. Look at businesses like Procter & Gamble, Coca-Cola, or Johnson & Johnson. These giants don't vanish in recessions. People still brush their teeth, drink soda, and take medicine, even when times are tough. What makes dividends powerful is that you get regular income, even if the stock price fluctuates. That means while others panic sell, you keep earning. And if you reinvest those dividends, you're not just protecting wealth, you're compounding it quietly. 2. Real estate in stable markets. Real estate isn't recession-proof by default, but the right kind is. Luxury properties, overpriced condos and vacation rentals, risky. But middle-income housing in growing cities or multifamily units in stable neighborhoods, solid gold. During economic downturns, people downsize. They look for affordability. That means demand often shifts toward rentals and basic housing. And if you own those properties, you benefit from that shift. What makes real estate powerful is that it generates cash flow through rent, offers tax advantages, and historically appreciates over time, even if short-term dips happen. In a recession, the key isn't fancy, it's functional. People always need a place to live. Invest accordingly. 3. Precious metals, especially gold. Gold isn't just shiny, it's strategic. For thousands of years, gold has been the go-to hedge during economic chaos, currency crashes, and financial instability. Why? Because it holds value when paper currencies don't. When inflation surges, when stock markets drop, when central banks panic, gold often rises. It's not meant to make you rich overnight. It's meant to preserve wealth when everything else burns. Adding even a small percentage of gold or silver to your portfolio can stabilize your assets and lower your risk exposure dramatically. And unlike stocks, gold has no debt, no management team, no quarterly earnings, just quiet strength. 4. Consumer staple stocks. Think about what people still buy in a recession. Toilet paper, toothpaste, bread, milk, cleaning products, medicine. These are called consumer staples, and the companies that make them are some of the most reliable performers during downturns. Businesses like Unilever, PepsiCo, and Colgate-Palmolive don't rely on hype or economic booms. Their products are essentials, bought on repeat in any economy. When consumer behavior tightens, non-essentials go first. But staples, they stay strong. Owning shares in these kinds of companies gives you steady income, strong pricing power, and resilience when the market shakes. 5. Treasury inflation, protected securities, TIPS. TIPS are U.S. government bonds that are indexed to inflation, which means as inflation rises, your investment grows too. During a recession, especially one caused by high inflation, most assets suffer. But TIPS protect your purchasing power. These are low-risk, government-backed, and pay interest every 6 months. They won't make you rich, but they're one of the safest places to park your money when everything else looks risky. If you're looking to preserve capital and stay ahead of inflation without betting on risky assets, TIPS are a smart play. 6. High-yield savings and money market accounts. Sometimes defense is the best defense. Recessions aren't just about growth, they're about survival. That's where high-yield savings accounts or money market accounts come in. These aren't sexy. They won't double your money, but they offer liquidity, safety, and reliable interest, all without market exposure. In volatile times, cash is power. Having access to liquid funds gives you flexibility to cover emergencies, seize opportunities, or just sleep better at night. Think of these not as investments to grow wealth, but as tools to hold the line when others are forced to sell at losses. 7. Low-cost index funds with defensive sector focus. Index funds are already powerful because they give you exposure to broad markets with low fees. But during a recession, targeting defensive sectors is key. That means choosing funds that lean into healthcare, utilities, energy, and consumer staples, industries that don't collapse during contractions. Instead of chasing the next hot trend, You anchor yourself in the companies that keep running when others freeze. Low-cost ETFs like Vanguard Consumer Staples ETF, VDC, or Healthcare Select Sector SPDR Fund, XLV, are built for this kind of market. You get diversification, resilience, and less volatility, all in one simple automated investment. 8. Skills and education. Yes, one of the best recession-proof investments isn't a stock or property, it's you. Investing in new skills, whether it's copywriting, coding, financial literacy, or marketing, creates personal leverage that no market crash can take from you. When businesses downsize, people with rare and valuable skills still earn. When companies freeze hiring, freelancers with in-demand skills still get paid. The ROI on self-education, especially during uncertain times, often beats any financial asset. It's recession-proof because it makes you an asset, not just your money. 9. Defensive mutual funds. Unlike aggressive growth funds, defensive mutual funds focus on stability and preservation of capital. They tend to include a mix of dividend-paying blue-chip stocks, short-term bonds, and recession-resistant sectors. These are ideal for conservative investors who want less volatility, lower downside risk, and modest returns with consistency. While others ride emotional roller coasters, your capital remains protected and still working for you in the background. When you can't predict the market, protect your wealth through strategy, not hope. 10. Essential services and infrastructure stocks. There are industries that governments and populations simply can't live without, even in crisis. Think of water utilities, waste management, public transit infrastructure, and broadband connectivity. Companies in these sectors often have long-term contracts, consistent cash flow, and insulation from economic mood swings. They're not flashy, but they're foundational. They power cities, homes, and daily life, which makes their revenue models surprisingly durable. Add exposure to infrastructure ETFs or stocks like American Water Works or Waste Management Inc., and you're holding recession-hardened value. 11th, international bonds and emerging market exposure. Diversifying beyond your local economy is smart in any climate, but during a recession, it becomes vital. If your country's market crashes, currency weakens, or inflation spirals, your local investments suffer. But international bonds or select emerging market funds can offer a hedge against domestic decline, especially in regions where growth is just beginning. Of course, this takes research. Not every country is stable, but spreading your capital across non-correlated economies makes you less vulnerable to localized crashes. Global resilience begins with global thinking. 12 REITs, real estate investment trusts, with focused portfolios. REITs give you real estate exposure without owning property directly. And the best part? Some REITs focus on recession-resilient sectors like healthcare facilities, warehouses, and grocery-anchored retail. Medical Properties Trust, Public Storage, and Realty Income Corp are examples of REITs that provide monthly income and recession durability. You avoid the hassles of tenants, maintenance, and mortgages, but still collect cash flow, benefit from asset growth, and maintain liquidity. REITs are ideal for investors who want real estate income with stock market flexibility. Best time to prepare is before the storm. Recessions don't ask for permission. They hit fast, shake the weak, and reward only the prepared. You can't control the economy, but you can control your positioning. These investments aren't about panic. They're about power. Power to hold, power to protect, power to grow when everyone else shrinks. Don't wait for headlines to scare you into action. The best moves are made before the crash, not after it. So whether you're investing in dividend stocks, consumer staples, precious metals, or your own skill set, remember this: recession-proofing isn't about fear, it's about foresight, and the time to act is now. If this video gave you the clarity you've been missing, like, comment, and subscribe, because the right knowledge at the right time is also an investment.